Risk profiling is the process of determining the optimal amount of risk that should or could be incorporated in your investment portfolio. So the obvious question is, what is risk? In general, risk can be defined as the uncertainty of the outcome of an anticipated event. In an investment sense, it could translate to a profit not being realized because of a setback which made the company you invested in go bust. Many factors contribute to your risk profile, and we will get to them, but broadly speaking, your risk profile will be determined by your risk tolerance, which is also known as your willingness to take risk, your ability to take risk, also known as your risk capacity, and your required rate of return. The goal of the risk profiling exercise is to balance these three components in order to afford you the best possible chance of realizing your financial goals. Your risk tolerance is a psychological trait each of us have. An advisor may utilize a risk questionnaire and discuss various investment scenarios with you in order to determine your emotional tolerance towards the ups and downs in the market. Your ability to take risk is influenced by many factors. Let's take a look at a number of them and determine whether they add or subtract from your ability to take risk. Let's look at job security. How secure is your monthly income? If it's not secure, obviously this will detract from your ability to take risk. Do you have an emergency fund? If not, once again, this will hamper your ability to take risk. How many financial dependents do you have? If none, this will add to your ability to take risk. Your time horizon? If you have a long time horizon, for example, you are still in the accumulation phase of saving for retirement, this will add to your ability to take risk. Do you need income from your investments? If so, the withdrawal rate, in other words, the income you take as a percentage of your total capital, will either add or subtract to your ability to take risk. Having determined your willingness and ability to take risk, you can now be categorized as being a cautious, moderate, or aggressive investor. Whichever category you fall in will point to an appropriate mix of low and high risk assets. This is commonly known as your asset allocation. For example, if your advisor determines you are a cautious investor, he would probably suggest a portfolio consisting of 75% low risk assets and 25% high risk assets. On the other hand, an aggressive investor might have a portfolio with 10% low-risk assets and 90% high-risk assets. Knowing all this, the next obvious question is, so what? And the answer is, to help you realize your financial goals. We as individuals have the unfortunate characteristic that we feel much more financial pain from a loss of capital as compared to an equal gain. What's also true is that the pain threshold of a cautious investor is much lower than that of an aggressive investor. The practical implication of this is that a cautious investor with a too aggressive asset allocation will reach a point at which the pain is too much and he will sell and realize a permanent capital loss. As a matter of fact, research has found this to be the main cause of wealth destruction by non-professional investors. More often than not, an investor will experience a shortfall in capital in order to satisfy his financial needs. For example, your kids are going to varsity in 10 years and you want to accumulate enough capital to cover the cost of at least one 3-year degree. Let's say 400,000 Rand. You can afford to save 2,000 Rand per month. In order to get to the 400,000 Rand goal, your investment will have to grow at about 10% per annum, which is your required rate of return. To achieve the required 10% rate of return, you would have to invest in an aggressive portfolio, which will probably include around 80% stocks. The problem, however, is that according to your ability and willingness to take risk, you should have invested in a cautious portfolio. This implies that something will have to change. If the financial goal and monthly savings amount is fixed, the only option is increasing your willingness to take risk, which can only be done by education. Understanding risk and balancing it with your financial goals is as, if not more, important as finding a trustworthy advisor or investment manager. Many a well-structured portfolio was ruined by not considering the investor's risk profile and or the advisor's inability or lack of coaching potential investors. Furthermore, equip yourself with at least a basic understanding of investment before venturing into the unknown.